Oh, welcome into another episode of the Fergus Spotlight Podcast. I'm your host, Jacob Bittner, joined by another returning guest. It feels like it happens more often than not now because the show's been around so long. I've had a lot of people on, and it's kind of fun to recycle some guests back onto the show. I mean, Matt and I, we realized that it's been like over 2 years because you were one of the original guests on the show.
I was early on, yeah.
You were an OG, so certainly has been a long, long time. I had the guys from Hedgeheads on not too long ago, last month or the month before. So fairly recently, we've had a financial deep dive. We talked about commodities mainly when those guys were on. Ryan and John are commodities brokers, commodity traders. You do a little bit different work. Obviously, you work with commodities. You advise people on commodities, but you're a financial advisor. You deal with a lot of retirement assets, things like that. I know I acquired a life insurance policy for my grandparents that was like Lutheran Brethren something, and it became Thrivent Financial. We talked about all of that, I think, in the first episode with you, as far as the history of Thrivent Financial, kind of the structure of Thrivent in our community, some different advisors. And so if you haven't got a chance to check that out, go back. You'll get some old Fergus Spotlight content, but go hear Matt's story. You can kind of hear about his life a little bit and what brought him into this career. But today we got a fun conversation, don't we? Yeah.
Good topics.
Good topics. I picked out some good ones here. We're going to be talking about the retirement system, whether or not the U.S. retirement system is broken. Spoiler alert. It probably is. We're going to talk about wealth gaps, generational wealth transfer. We're set to see a huge transfer of money, probably, I think, the largest in history here over the next 10 years or so.
15.
We'll talk about that. We're going to talk about, maybe spend a little time. I don't know if we don't want to bore the people. We're going to talk about the Fed and interest rates, what it all means. I know we've talked about that a little bit on the show, but we'll talk about that because that's super relevant. If people don't understand that, we'll try to make some sense of that. We're going to maybe get into crypto. I know when I talked to you a couple of years ago, crypto ETFs were just getting started. So there's definitely been a lot of change and legitimizing of that industry for like major financial and like it's not as speculative, weird. You're weird for investing that as it was just even back in like 2020. So
absolutely.
And then we'll finish off by talking a little bit of the psychology of money and behavioral finance. So certainly a lot to talk about here today for sure.
Absolutely, man. I for those who know me, my brain is just a never-ending cycle of analogies, and so I pride myself on being able to explain things in a way that it makes sense and it's easy, but it'll be interesting to see if I can weave in and out of these analogies this whole time.
I love it.
So let me know if I start to go too deep into them. It's like what was that movie where there was like multiple layers of dreams? Inception.
Oh, Inception.
Sometimes I get like 3 layers deep of analogies, and then I have to weave my way back out. So
we'll keep you on track here. Yeah. We'll keep you on track. It'll be good. Before we get into the meat of this conversation, some sponsors to thank here: Stumbeano's Coffee, Atlas Outdoor Services, Outstate Brewing, Victor Lundeen's, Fergus Home and Hardware, Liberty Business Systems, Wayne Schuett with Century 21 Atwood, Dr. Zack Chiropractic, and Elks Point Bar and Grill. So shout out to all the sponsors. Appreciate you guys. Also, disclosure time. Nothing you're about to hear is financial advice. This is for entertainment and educational purposes only. And so take that for what it is. If you want financial advice, you can call Matt and get some like official financial advice, but this podcast is not it. This is certainly don't go out and make big financial decisions based off of what we say here.
Absolutely.
Or do it, but it's not our fault.
Yeah, the opinions I share, I'll be clear when this is a Matt opinion or more of a Thrivent Financial sort of industry opinion, that type of thing. Most of it will be sort of my own thoughts. Everybody's got their own perspective, but definitely more my opinion than representing Thrivent as an organization, exactly how they think of things.
Yeah. All right. Well, catch up the people a little bit on the last couple years of life. What you feel like is relevant as far as maybe the financial landscape, your job here locally, if anything's changed with Thrivent locally here over the last couple years since I talked to you.
Yeah. So coming up on year 4 for me, a lot has changed in the last year. So I joined a team with Thomas Larson. And then actually just a couple months ago, we hired another advisor named Rena Simon. She was a Stegan, used to be Seth Rena Stegan, and now she's Rena Simon. And so that's her. And then Heather Kleinschmidt is our office professional. And so in the last couple of years since I last was on, I used to be an independent advisor. Now I'm a part of a team of 3 advisors and one office staff person. And I'm pretty sure our location moved too from when we interviewed. So we're in the office right across from Fiesta Brava in that L-shaped building. Used to be the old bank building, was Keller Williams. Now it's Trilogy Realty. We're in the southeast corner of that building. So,
and what are the benefits of being a part of that like team with Thrivent versus being an independent person with Thrivent?
Great question. So a lot of it boils down to experience and expertise, right? So me being younger, having little kids, those types of things. If there's somebody who comes in and says, hey, I just got married, hey, I just started a family, what are some of the things I should be thinking about? Well, I have a little bit more experience and expertise with maybe that type of person or group of people, whereas my teammate Tom, if they're coming in saying, hey, I'm leaving my job, tell me about COBRA, what should I know about, when should I take Social Security, so what it affords us is the ability to specialize and then provide the best possible advice and service based on what the client's looking for. So if someone's coming in saying, I got questions about COBRA, I'm like, Tom's your guy. I'd love to help you, but I want to give you the best option available. If someone says, hey, I need life insurance because I just had a kid, that's more my realm, right? That's what I help with. And so it affords us the ability to provide even better service, because I might be a B when it comes to, COBRA, but Tom's an A. And so we're providing A service to that client, and I'm an A when it comes to young family planning. And so it's just better service for everybody.
Gotcha. And then you've got your office assistants that you guys kind of all mutually pay into to have somebody there to help you with phone calls, and stuff like that. And
so that way, if we're in a meeting, right, Heather's still taking the call, she's still scheduling the appointment. She's autonomous in many ways as well. And so you're not left waiting for 3 days for us to get you that form that you need printed, because Heather can do that for you when she answers the call, and it just kind of keeps the process going. It takes more off of our plate so that more people can be served at the time that they want to be served.
Love it. Love it. So you deal with a lot of retirement related questions then. Certainly life insurance is more tied into like actually dying, but retirement, this system that we've built, we've managed to find ourselves in. What do you think of it? Is it good? Are we in good hands here?
It's a great question. So many different directions I could go. I think one of the flaws unilaterally that I see, regardless of your age, where you work, those types of things, right? The 401k is theoretically meant to replace pensions, right? So many companies don't have pensions anymore, and they now have 401ks, and they say this is going to be the nest egg you set aside and grow, and then when you go to retire, you're going to take income. But they say, hey, congratulations, we've hired you. You have 3 minutes to fill out this form that's supposed to secure your entire retirement. And people are saying, I don't know what to invest in. Should I be aggressive? Should I be conservative? What should I be? And so often people aren't given the guidance and given the clarity to say, hey, you're 35, you should be an aggressive investor. You have 30 years of investing, right? Well, what does it mean to be aggressive? Let's talk about that, right? So many times aggressive is a negative connotation, but with investments, aggressive isn't negative. It just means you have higher upside, right? And we'll get into that behavioral finance thing, right? And that ties into that. But I think that's one of the biggest problems is it's a system that absolutely has its flaws, but even more so, it's a system that people aren't even given knowledge, given advice, given, clarity on how to navigate that system. And they're sort of just like, it's like circling answers at a test you didn't study for. You're just kind of hoping that you get a 70 and pass and thinking, 40, 30 years from now when I need this money, I hope it's there.
Right.
And then the other thing too with it as well that I think a lot of people don't think about is back when these were really started, we were sort of in a historically high income tax environment. And so it made sense to say, hey, we're going to not pay taxes today, build this money, and then later on when I retire, theoretically, I'm going to be making less money and taxes. So by making less money, I'm going to pay less taxes on these dollars.
Correct. Yeah.
And what we've seen is the people who've retired and the tax rate has gone down compared to when it was super high, that's paid off. But where we fail to sort of do the math is to say, well, what's the effect of compound interest? If I'm a 25-year-old starting a 401k, right? Even if tax rates stayed the exact same rate between today and when I retire, say 40 years from now, when you factor in compound interest, if I've put in $300,000 and it's grown to be worth $1 million, and now I owe taxes on all $1 million, is that really a better deal? Is that really more money in your pocket? Right. And so I think the tax implications as well of it used to make a lot of sense to postpone when you're paying income taxes. And now, given sort of the environment where tax rates are, when you start investing, that's not always the right decision now.
Interesting. Yeah. So I think it was designed, it says here, it was introduced, the 401k system was introduced, not, like you said, not as a replacement for pensions, but it was created to as a tax haven or a shelter for wealthy executives, people who were making, like you said, right, making so much money, trying to stay in lower tax brackets, deferring this payment essentially. And then somewhere along the line, the company decided, hey, this looks like a pretty good way to shift responsibility onto the individual rather than having us take on the responsibility of having to pay this person for the rest of their life, which is the difference between a pension and a 401k, right? Pension you get for life. And as life expectancy goes up, that becomes a problem for companies that are having to pay out pensions higher than projected. And then it also becomes a problem for people who have a 401k that are planning for 15 or however many years of retirement, and all of a sudden they're looking at 30 or 40 years of retirement.
Yep.
It's actually, it was staggering to find out that the average 401k balance for those aged 55 to 64 is less than $100,000. So not going to do it. That's just simply not going to do it, So I don't have much here on the history of Social Security. Do you know how that system has kind of come to be over the years, or the flaws in that? Because that's going to run out by 2035 or something.
Yep. I don't know. I know some, but I don't want to venture into somewhere where maybe I give false information. But I do know as it currently stands, Social Security is sort of predicated or set up in a system where if you pay $1, then they can pay you back $1.25 when you go on to Social Security. Now, a lot of people are seeing these, and I know you have the exact date. Maybe it's like 2034, or when they say that Social Security is supposed to run out.
Yeah, it says 2034.
2034, okay.
And it wouldn't run out. It says without reform, benefits could be cut by 20 to 25%. So it's that's when the fund basically goes insolvent.
Yep. So a common thing that people will hear is I think Social Security is going to be gone, right? It's not going to be around. I got to take it now because it's not going to be here. That 2034 number, a lot of times people mistake that to say they're out of money. But what actually changes is rather than the program going from you put in $1, it pays out $1.25, it goes to say you put in $1, you get paid $1, right? And so that's that lessening it by 20%, right?
Right.
And that type of thing. And so there's almost on a daily basis, people are asking us, how can I trust that my Social Security is going to be there and those types of things. I will say the past does not guarantee the future, but when we look at how tax law changes have happened, how they've extended the required minimum distribution age, and all these different changes they've made is it tends to happen where they sort of grandfather people in and say, okay, starting if you were born after 1964, this is your new reality. If you were born after 1970, this is your new reality. And so there's been studies that have shown that if they extend out the retirement age, so rather than saying, okay, 67, your full retirement age, now it's 68 if you were born after, and then it's 70. So for you and I, who know, like, full retirement age might be 75 by the time we get there, right? And so while it's they're
just going to keep making us work longer.
Yeah. Right.
The system is designed to just, I mean, well, and this is bring that point. In 1960, there were 5.1 workers per retiree. Today, it's 2.8 and falling. Yeah. So you have more retirees than the workforce can support. And obviously things like birth rate and all those things that, like, when you hear like the super global elites like talking about like, oh, we're worried about birth rate and stuff. It's like, yeah, because they're like the ones who are like designing this system and seeing the flaws in it, you know. And that's just like I suppose it's not too easy to see the fact that like you need more people on your planet coming up to take care of the people that are gonna not be able to take care of themselves in old age or whatever, you know.
The reality too with it is the numbers look so bad just with our deficit and things like that, that there's two different sides of the political aisle. One says cut government spending, the other says tax the wealthy. And both sort of at least project to say this is the answer to our problem. The problem is when you run the math, just one of those does not create sustainability. And the reality is that there's going to have to be a little bit of both. Like taxes we're going to have to increase our revenue to make up for this. And we're also going to have to lower our costs. Now, could our government ever come to the middle of the aisle and actually make a decision, you know, bipartisan? Who knows? We'll see. But we're sort of staring down at the barrel of a problem that will require bipartisan agreement to say we're going to do this and we're going to do this, and until we can do that, we won't see significant sustainable change. They're just going to sort of put band-aids on it as long as they can.
Yeah. Well, we'll talk more about retirement as we get into some of these other ones. Certainly this next topic, generational wealth transfer, that's obviously super tied into the retirement system too. And thoughts on that? It says here 84 to 90 trillion dollars in assets are expected to transfer from baby boomers to Gen X, millennials, and Gen Z over the next 20 to 25 years. It's the largest wealth transfer in U.S. history, often referred to as the Great Wealth Transfer. Roughly 16 trillion is projected to transfer by 2030 alone.
Yeah, it's significant, obviously. I mean, those are the size of numbers that don't seem real, right? We can't comprehend that, you know, being a real number. But yeah, there's so many avenues to go down this. I think one of the things that we in our practice are incredibly intentional about and I think do a great job is through tax efficiency planning. And so I'll give an example. Let's say my dad's already passed away and my mom has these investment assets, and she may have a non-qualified annuity that has $300,000 and she only put $100,000. So there's $200,000 of what's called gain, right? It's earned $200,000 in that contract. Or she has a non-qualified investment account, right? This is just, let's call it Apple stock. She bought $100,000 of Apple stock. It's worth $300,000. Well, in that non-qualified annuity, when she passes away, I get to inherit $200,000 of taxable gain that I have to pay in the year that I inherit it. In the case of that Apple stock portfolio, I get what's called a step up in cost basis. So it's as if I spent $300 on the stock, even though I spent $0, and now the baseline starts at $300. So I only owe taxes on whatever gain happens above that $300 number. And so there's a numerous amount of strategies that you can employ, even as simple as I have $100,000 or I have $300,000, 200 is growth. Where should I put it? Well, depending on what sort of tool that you put it in can substantially impact the amount of taxes you pay. So one thing we talk about in our practice is I say our money goes to 3 Ps: the people we love, the places we love, and the politicians that maybe we don't love so much. And there's a reason why I use my middle finger for that third P, right? Because nobody likes paying taxes. And so for us, we're saying, hey, how do we minimize that third P as much as possible? We call it disinheriting Uncle Sam, so that the people and places get the most of our hard-earned dollars when that time comes that Lord calls us home and there's money left over to go to our family.
Right.
Right.
And these are huge. I mean, the huge conversations that are happening in legislation right now regarding wealth tax and regarding transfer of wealth and that sort of thing.
Mm-hmm.
And the system is bound to change. It obviously the catch here and everything is the unequal distribution of that. The top 10% of households hold 70+% of all wealth. There's also and we've talked about it on this show before, is the racial and socioeconomic disparities. So you have a system. What does it say here? I forget the percentage. Yeah, white families are 5 to 10 times more likely to inherit significant wealth than Black or Hispanic families. So there's still this, and I've talked about it in length on this, and I don't really care to put my foot in my mouth anymore. But I'm fully against reparations or anything along those lines. But when it comes to looking at this generational wealth and the fact that a lot of this generational wealth tracks back to periods in our country where we had enslaved individuals, we had women who weren't allowed to vote or take out loans for themselves. Like, there's a lot of periods of history and a lot of scars our country has regarding financial freedoms, I think, that have set up certain demographics of people for more success in the future than others. So I do think that there's things that are going to be done in our system to level the playing field still. I mean, I don't know. Thoughts on that?
Yeah, no, I think one of the non-legislative but playing field leveling factors is access to education.
Right.
Now, you got an internet connection, pull up YouTube, right? Watch, like, honestly, how I got started even way back in the day. I've never been somebody that you would look at and be like, man, he's great with money. I'm the guy that's like, really? You got a new pair of shoes? Didn't you just buy another? Like, I was always like, it couldn't come out of my pocket fast enough. But what happened was I went through the Dave Ramsey program and paid down some debt and all this stuff. And then he started talking about investing. So I'm like, I don't know anything about investing. So I just watched stuff on YouTube, right? That's where I learned about compound interest. That's where I learned about an HSA, all these different things. And so I think access to information and education, that being sort of leveled out to be equally accessible, regardless of background or anything like that, I think is going to be a major catalyst to say now there are folks that, even if they didn't go to college, have access to great financial advice and information.
Correct.
And education, whereas before it was sort of limited to the college.
Correct.
That type of thing.
Certainly that will be a factor. And if you're out there listening and you're like, everyone's going to, all this wealth transfer, I'm not getting any money. Well, you're not alone, because 70% of millennials, it says here, will receive nothing. You get nothing. You get none. So you're not alone if you're not getting any money. It's just the way it is. We're working towards a even more top heavy system than we've had in the past. One of the big challenges with these inheritance, and you mentioned a little bit, and now information is free, but there's a huge lack of financial literacy. And it says here, most studies show 70% of wealth is lost. 70% of the wealth inherited is lost by the second generation, and 90% by the third, often due to poor planning or spending. Like, if you're not the one who earned it and you didn't put in the work to do it, and you don't have the financial literacy to keep it or do something with it, it's going to be gone in 2 generations.
Yep. I mean, look at it's so much of the human psychology, and I mean, look at the stats around people who win the lottery. Right. I mean, it's an abysmal percentage of people that win the lottery that actually maintain their wealth. And so, yeah, I think I've heard someone say before, there's a difference between being rich and being wealthy. The wealthy are the ones that use their money to create sustainable, generational, money that lasts, and the rich sort of spend it away on frivolous things that eventually one day will, come catch up with you.
Right. I have a buddy who's getting married, and I'm going to give him a bar of silver for his wedding.
Nice.
And I am convinced that, depending on what other assets or whatever things people are giving, I'm convinced that a bar of silver is, fast forward 10, 15 years, 20 years, maybe not even that long. And it's probably going to be the most valuable gift that you got at your wedding.
Yeah,
the world erodes away. Like everything kind of erodes away. We didn't even put silver on here at all. And you and I could talk silver forever. And the price is good. It's not at $50 like I thought it was going to be by this time. Last time I talked to you, but it's getting there, and it's getting there slower. There's still time to get on the silver train if you want to ride it to $50.
My lots of conversations with my dad. He's right in that same boat with you. His thought is that the gap between the value of gold and silver makes no sense, and so he's sort of making a bet on to say that silver needs to catch up to gold,
right?
And feels like gold is overvalued right now and silver's undervalued.
Right.
So yeah, I mean, almost a weekly conversation with my dad. Hey, did you see what silver did today? Like, he's making that bet and sticking with it.
Yeah, so, absolutely. Well, maybe you'll get some of that wealth, that generational silver wealth transferred down to you if you're lucky.
And I was just having a conversation with Dennis Bowman, who likes to host a poker night. He said
I played last week with Bowman.
Yeah, so I told him, I said, I only silver. I had 4 ounces of silver, or what the little coins, ounces, right?
Yeah.
Okay, yeah. Shows how much I know, right?
Yeah.
But I was like, I have 4 ounces of silver because I won it at a poker night at Bittner's like years ago. It's like, that's the only silver I have, but I still have it. So that's
good. That's good. That's crazy to me that you don't have it, that you don't have more as a financial advisor. You don't have more, huh?
My personal thought or opinion is I favor investing over it. I think precious metals in a lot of ways are a hedge against inflation, a hedge against a downturn in the market, things like that. But I think, honestly, a big part of it too is, I don't know if I'd call it laziness, but I would say with silver, the barrier to actually turn around and see the profit and experience the profit and use it is, obviously you got to buy it, then you got to store it, and then you got to turn around and sell it in order to sort of go through that process.
Correct. And you're going to pay a premium on the way in, and you're maybe going to get spot price at best on the way out.
Yep. And so for me, I'm favoring investing in the markets right now. And that's my own personal bias. I mean, I tell people all the time when I meet with them, my bias is towards risk. I think if you look at S&P 500 returns over the last nearly 100 years, it's 10.5%, on average. Now, obviously there was the Great Depression, and then we've seen peaks and valleys within that, but, and again, I've already said it, but past performance doesn't guarantee future returns. But, and actually my wife gets upset with me because I have very little emotional connection to money. And so I have the ability to see my portfolio drop by 15%, and I don't lose a wink of sleep because it's a numbers game for me. I'm playing the numbers. I know that barring a major, never been done in history event in our country or in our world, I'm going to come out ahead.
Yeah, that's going to happen. I bet you we'll see. We might see one of those before retirement. I actually think that there's a chance that we do see one of the most catastrophic. I mean, we're still in this fiat bubble that has to pop. We have to. We talked about this with Ryan and John from the Hedge Heads, but like this system it's not a matter of if this comes unraveled for the world. It's when. We have this. And I think that, it might make sense for some of this stuff to go down in the next 5, 10, 15 years here with all this wealth being transferred as far as currency looking radically different on the other side of it. But we'll get maybe into that a little bit more when we get into crypto as far as like alternative assets at retirement, or like I'm a big fan of silver and crypto, and I've said this, like it's probably sound like a broken record at this point, but when you have your 401k, or if you buy stock backed silver commodity rather than holding the physical silver, like your exit strategy is cash, or your exit strategy is liquidating within whatever broker, whatever platform you're trading in. You're liquidating that for your dollar and you're moving on your way. And there's just so much more you can do with a physical asset if there were to be a currency crisis. Cryptocurrency as well. There's just so much more flexibility if you're in those assets directly. You just have unlimited options to trade it for anything else that you need, or anything else that's more relevant at that time. So
here's the analogy I use with that, because I totally understand where you're coming, and I'm in no way am I degrading precious metals, crypto. I do think it's a great part of a portfolio, but I always tell people, if you're building a house, right, you're kind of building a financial house throughout your accumulation years, right? You have limited assets. You only have a certain amount of land or money or whatever to build. And I tell people, if you have a family, or those types of things, and your doomsday bunker is a 6-bedroom, 3-bath bunker, but your home that you build for your family is a 1-bed, 1-bath, right? Your allocation of your assets is misconstrued. And so I'm not telling people don't have a bunker in case of an emergency, but what I am telling them is, if you're living every single day in that home with your family, focus more of your assets to building 3-bed, 2-bath home and a 2-bed, 2-bath bunker, rather than a misallocation of your assets. And so for me, how that practically and personally works out is, I'm favoring fully funding my Roth every year. I'm funding my HSA every year. Those are the rooms that I'm building in my residence. And until I feel that my primary residence has sufficiently been built, and if I say I got more land and room to build, then that's where I say, okay, time to explore maybe some bunker building in the case that things were to go wrong. I don't have the overwhelming amount of assets to both be building a primary home and a bunker right now. And
you're talking to a guy who lives in a bunker.
I know I am.
I live in the bunker. That's all I got, son.
And so that's the analogy I use, right? The picture I have in my head.
Yeah. No, I need to start doing some more things. I'm not fully financially literate. I would consider, I probably have like knowledge that's like just super dangerous if unchecked, as far, I mean, like, I think once you wake up to the fact, to realizing what fiat currency is, I think that like, it's really easy to just give up on that, like want to just give up on that system completely. It's really easy to just want to like, but that's why it takes people like you who understand like these traditional financial assets a little bit more. I mean, I certainly need to contribute into a HSA. We've got some stuff going on at work here. We're an ESOP, so that's a different retirement thing we didn't really talk about. We won't talk about that, but I don't get a match on a 401k because we have an ESOP here. And so there's certainly some different things I'm starting to try and think about too, but in general, I'm just like super afraid the world's going to come crashing down. So, but we can talk about that maybe a little bit more. We'll get into crypto, but the Federal Reserve and interest rates. We talked about the Federal Reserve being created in 1913, sort of as this, the Jekyll Island, read about it, listen about it. There's all kinds of content about how the Fed came to be. It was chartered. It was only supposed to be chartered for X amount of years, 20, 40 years or whatever. And it's far overextended its charter as a central bank. And so there's a lot of, like I said, thoughts on the Federal Reserve.
Just open book.
That's
I think for the people that are saying, okay, I am hearing Fed is keeping rates or lowering or higher, and like, what the heck does that mean? the way I describe it to people is basically they are trying to regulate how expensive it is to borrow money.
To create money.
Yeah, to create money, or for the lender to borrow it, those types of things. Now, I won't pretend to understand all the different elements that go into why are we. I mean, there's the big ones: the unemployment, the inflation rate.
Right.
There's all those things, and how that recipe sort of mixes together to produce a rate hike or decrease. I don't know, but that's up to them. But I think the thing for sort of the layman is just to say, okay, it's essentially them trying to turn the dials to either make it easier to make money, to borrow money, or to make it more difficult for the sake of this massive shift. So the way that I, again, analogies is think of the Fed is the captain behind a massive cargo ship, right? And that cargo ship is our economy. And essentially what they're doing is they're looking out 500 miles and saying, hey, there's a hurricane over here and there's this here and this here. And they're trying to gradually shift the direction of the economy or of that boat to say, we're trying to avoid that hurricane that's on the horizon over there. And so they're projecting out the weather that our economy is heading towards. And then through little tiny things like a 0.25% interest hike, sort of shifting, 5 degrees that way so that we'll end up missing the storm. Or the opposite might say, storm is behind us. We got nothing but blue skies and sunshine. Now maybe they speed the boat up because they're saying, hey, we got clear waters. Let's go. That's essentially what they're doing. You can get so deep into trying to understand it all. This is my job and I get overwhelmed by it, but that's how I describe, kind of for the layman to say, what should I know about it and why are they doing it?
Yeah. And the Fed does that through the federal funds rate. So the Fed sets a federal funds rate, which, it influences how much it costs for banks to borrow to each other. Yep. And so that's one of the biggest misconceptions that I had before I started talking to you finance people about this topic was that the Federal Reserve creates money, and it's not true. They set the rate at which these banks basically are. That's how, and that's a part of me that like I don't understand, and I can't wrap my head around like the percentage of money that doesn't exist. Like it's like 90% of money doesn't actually exist. It's all just like part of this fake system of borrowing on borrowing on borrowing on borrowing, and but the main job of the Fed, managing inflation levels, promoting maximum employment, and stabilizing the financial system. So when the Fed raises rates, borrowing becomes more expensive. When the Fed lowers rates, it stimulates the economy by making borrowing cheaper. Higher rates equals less borrowing. Lower rates equals more borrowing. Very simple. Yeah. So,
and typically borrowing is tied to economic activity, right? So if inflation is low and unemployment is low, right, then they might say, okay, or actually if inflation is low and unemployment is high, then they say we want to stimulate money being cheap. So 2 years ago, maybe I wanted to start a apparel business. But I went to a bank and they said, well, it's going to be 6% on that loan. I'm like, nah, that's too much, right? But now Fed lowers rates, borrowing money got cheaper. And if it's 3% now on that loan, maybe me as an entrepreneur might be more willing to go start that business. Little dominoes like that are dropping all over the place that's sort of stimulating the economy and creating. And then what ends up happening is too much borrowing, too much leverage, inflation goes up, right? And then they say, okay, now it's time to shift the ship a little bit and move the direction. And so that's when they hire rates and so on and so forth.
Obviously, COVID was like the biggest problem that we like that we're still we'll be dealing with that for decades, as far as the financial impact that it's had. I just got done talking with Katie Gano about childcare, and we're starting to feel the effects of businesses, specifically in the childcare industry, that were being subsidized by COVID or subsidized during this period of time, and all those subsidies are ending now. And so you're seeing and it's going to be ripple effects all over you're seeing restaurants shut down now that like arguably should have not made it through that period of time, or like businesses that should have, and it sounds terrible to say it, but like should have failed when we had that crisis, which we never should have had, but failed. They should have failed then, and they didn't. And now the government can't support them forever. So they're slowly pulling back on all this economic support that they were offering during the pandemic. And now we're really starting to see shortages in childcare. We're starting to see collapses in industries. I think the financial system becomes more and more and more fragile as the stimulation comes out of the economy. But it says we're in a higher for longer era where rates may stay elevated even if inflation cools. So rates are high, not like historically astronomically high. I would say middle of the road historically, right?
Yeah. Yeah, I mean, historically, you go back to the 80s and it was double digits. I mean, like I bought how long ago did I buy my first house? I think like 2015, something like that. And I mean, for my I've bought and sold, I think I've sold 3 houses and I've bought 4. And that entire time, the interest rates were between 3 and 5%. Right. And so our parents are saying, you know, if I was looking for a house right now and thinking, man, 7%, our parents are going, boo hoo. When your dad and I bought our house, it was 18%.
Yeah. And it cost $18,000. So shut up.
Yeah, that's a fact. Yeah.
Right. I mean, like, it's irrelevant.
Yeah.
It's irrelevant to how much it costs to borrow then versus what it costs to borrow now, because money was just different.
And there you see the effects of inflation. Right? Because inflation is a lot to do with, now you're going to have to throw down $400,000 to buy a house when our parents bought that same house for $85,000. Right? So, you know, there's so many different factors that go into it. And the Fed, especially our current Fed leader, is very sensitive to insecurity, not like he's insecure, but just not knowing what the future holds, right? So all this tariff talk, right? What's going to be the outcome with that? What's going to be the resolution to the war between Ukraine and Russia, right? What's China got going on? They're sort of teetering on all sorts of issues right now. And so that's why the Fed, even though they might say, hey, inflation's low and unemployment's where we want it to be, they're sort of looking there saying, hey, but there's all these things sort of teetering on the fence that are massive influencers that we want to see that resolved or settled, or at least predictable at a minimum, before they're willing to say, okay, time to lower rates.
There's way too much potential energy in the world economy right now with all the everything. And we talked about tariffs more, and we won't talk about that at all today. We talked about that with the commodities guys because it's really relevant to commodities. But certainly there's a big play going on when you have a bond market that is backed by the Chinese and the Japanese. And when all of that starts to come unraveled, the Federal Reserve won't be able to buy back enough bonds to save the system that is out there. So, yeah.
We're playing a game of chicken right now. High stakes chicken right now.
Yep. So we got 2 categories here, and I think they play hand in hand really well. Crypto and alternative assets and the psychology of money. Why, specifically, why we make dumb decisions when we know there's better decisions to be made.
Dude, I would say half of my job is more of a psychologist than an advisor. I mean, it's cutting through that stuff.
Totally,
and getting to the baseline of it. I always use our and this is a little bit of a contrarian perspective, and so maybe we'll bond over this because this is kind of bunker-ish, type of mindset. But I always remind people, so our media, our news, is our economy is predicated on attention. It's all ad dollars, right? I just saw an article that 97% of last year's revenue for Meta was advertising dollars. It's all about advertising. And the way you get advertising is you get eyeballs. The way you get eyeballs is you sensationalize, you create fear, or you create anxiety. They've done, at this point, trillions of dollars of human psychology research to say what gets the biggest response. And the two biggest emotions that get response and engagement is fear, and then anxiety and anger are sort of a part of that as well. And so,
wow.
So what our entire economic informational system is built on is sensationalism, so that you can sell more ad dollars. And so I'm not I don't know this to be true, but sort of what I feel and I see is that our generation is being sort of misled into being very anxious and fearful of certain things because of the way that our media is now being incentivized to get to us and the way that they make money.
Bam, they've been working on me my whole life. and really, when you look at something like cryptocurrency, it's kind of the epitome of, basic behavioral finance 101 studies emotions, biases, and social influences that affect financial decisions, often irrationally. I mean, look at the GameStop saga, and that, like, they broke the system so bad they had to turn it off. The rich people had to turn it off, so they could fix it and then make money when it went back the other way. But it's really, really interesting. So, like, you don't get people taking Bitcoin from nothing up to $110,000 per Bitcoin without this mob mentality. We're all scared of the system together. Oh, I paused it there. We'll get it. The recording maybe pause for a second there, but I'll get it off the video. But yeah, we had like major movement as far as the people taking back the momentum, and that was all behavioral. That's like all psychology of investing. I mean, I feel like Bitcoin is the social or the economic experiment that, have we ever seen anything like this before?
Yeah, the idea to decentralize so that you're taking the power away from individuals or the top,
the government and the top and all of that. So, but obviously, the reason why people make bad moves. This is the thing, because it's not just about crypto or investing in anything. It's oftentimes it's not investing at all, or it's the idea that, like, yeah, I'm sure this $20 now can be $50 when I retire, but I'd rather just go have this dinner out or whatever. Yeah. That's the simple financial decisions that we all make on a daily basis without even realizing we're making them.
Yeah. I think the psychology of investing is interesting too, because you think about, I'll give two different examples. If you went out and I drive an F-150, so I'm going to use that as an example. I go buy a brand new F-150. It's probably at this point $60,000, $65,000. And I pull off, and let's say on my dashboard it said how much my truck was worth. And it says 65 on my dashboard. And the second I cross that threshold onto the road, it drops to like 45,000. What person would turn right back around and be like, oh my gosh, my truck's lost value. I got to sell this back to the dealership so it doesn't drop more, so that I guarantee I lose $20,000. Whereas if I drive that truck for 7 years, pay it off, and then I go and sell it back for, and that's a depreciating asset. That's not with appreciating assets like investments. The other thing I think of is a house. If I bought my house for $300,000 and 2008 happens again, and housing market crashes and all that stuff, and the bank's saying, hey, it's worth $250 now. It makes sense to go sell my house because I'm freaking out that it's worth $50,000 less right now? No, the only way that I experience the loss of value of my home is if I sell it, or the value of my truck is if I sell it.
Right.
But when it comes to investing, so many people have the opposite mindset, is they think it's this endless, bottomless pit that's never going to stop, when the reality, you look at the history of the S&P 500, the worst it ever got, I believe, was 54%. That's the worst in history of almost the last 100 years. It's the worst the bottom has ever been. So you go back to 2008, drop 54%, or right around 50%. And then for the next 9 years, it returned 401%. Then you go to COVID. There was a 1 month period, it dropped 34%. And then for the next, I can't even remember the exact amount of years, over 100% returns. And so it's so interesting to me that the psychology, like nobody that's sane would sell their truck or their house or assets they have like that if it dropped in value all of a sudden. But with investments, we're the opposite. When I'm saying, and when you can take the emotion out of it, is to say, hey, the value of this has just dropped. I know historically speaking, it's coming right back. It's on a 35% discount right now. You better believe I'm buying more of it. I just, even in my own personal experience, CrowdStrike. So in my Roth IRA, I own CrowdStrike stock, and that is like a cybersecurity and some of that stuff. They were the company. I don't know if you remember when it was like the blue screen of death where all the flights were canceled and all that stuff because there was a national outage.
Yeah.
CrowdStrike was the company that was responsible. Like they made a mistake that caused that. Their stock dropped by like 50%. And I'm just thinking, okay, this is a great company. I've looked at the financials. I've looked at everything. And this is a moment in time that they're embarrassed. They got caught with their pants down a little bit. But I'm thinking, I got 30 more years of investing, and I think this company's going to be around for the long haul. So I dumped a bunch more money into it, and it's up 300% since then.
Yeah.
That when you take away the emotion and you play the numbers game, that's where you can really start.
Yeah, I have an IRA right now that I found. I messaged you about this, but I was, and it's funny because I don't know what it was that pissed me off about Schwab or whatever, but this was when all of the chaos was going on with Robinhood shutting off, taking away buy buttons and shutting off stocks and basically rigging the market. And it was clear that that's what happened. It's clear to me. I mean, watch the movie, what's it called? The new movie that's all about the net. I think it's called GameStop, maybe. But it's on Netflix. It's really good. And it kind of depicts it. It depicts all well. But the bottom line is the market was rigged. And I think that the amount of confidence in the market as a whole dropped. Like I don't think our generation will ever be like confident in the fact that the system's not rigged after experiencing that what we all went through during the, I'm sure, I feel like everybody was buying. Were you buying GameStop? Were you in on this momentum investing or not?
I didn't do it. No.
But Robinhood really dropped the pooch there, and they probably had the worst public image of any financial company maybe ever because of the amount of people that were on their platform and how much they just screwed them over. Well, I bought Robinhood. I bought a couple 100 shares of Robinhood in my IRA at like $10 a share, and just didn't. I kind of forgot I had made that investment actually, but that's a perfect example of a company like just about the worst press. Like nobody felt good about the company Robinhood at that period of time, and now I mean I feel like this is worth a conversation worth having when it comes to cryptocurrency, the psychology of money, the technological shifts that we experience that allow people to take on financial investing for themselves on their own, do it themselves. You don't have to call your broker. You don't, it's good to have a Matt McKinney, but certainly we have apps that are making it really, really idiot proof. Well, not idiot proof because it's never, investing is never idiot proof, but like, you see what I'm saying? Like these super good user-friendly apps that are, you're competing with all those, I assume, as you're.
Yeah, no, honestly, like I think, and I want to step back and say one thing. I don't know if somebody's going to fact check me on the CrowdStrike, I don't know that it's literally 300%. I just know it's up substantially. So
right. Fair enough.
Yeah. So it's gone up crazy from then. But anyways, I always tell people like, so if you came to me and said, hey, I really like Apple, they're kind of struggling this year, I think they're going to come out of it and be fine. I want to buy some Apple stock with you. I'll tell people straight up, go do it on Robinhood, E-Trade. They're 0% commission. It's cheaper for you to go do that. But so that's not sort of the realm in which I serve people. And I'm not interested in a $15 commission for you to buy Apple stock. Like I'm not going to nickel and dime you for that, right? But what I am here to say is to say, while you can maybe get commission free over here, or maybe the fee's a little bit lower over there, you're sort of the driver, right? You're doing everything. And I think the value that I hope to provide is to be a sounding board, to provide some of that clarity, to take some of the emotion out and say, hey, let's talk about this. You just called me and said, hey, I want to sell out of my IRA. It dropped by 10%. The value I bring is that I'm going to talk you out of that decision because that's not a good decision. So maybe my fee is 0.2% higher, but I just saved you over the life of your investment, 20 times that because I was able to give you the guidance and clarity to do that.
Right.
So I always tell people, like, if you're super, super fee sensitive, I have no issue with that, right? It's kind of the same thing of somebody who's saying, it's going to be cheaper for me to go buy all the materials from Home Depot and buy my house and build my house than it is for me to hire a builder and have them build my house. I don't know how to build a house. So that extra cost of their expertise, all of that is worth it for me so that I can sit back and say it's being taken care of by an expert.
Yep.
And I don't have to worry about trying to learn how to build a house on the fly.
Yep.
So that's sort of the difference, I would say.
Absolutely. And I think we spent a lot of time talking about the different like services and stuff that you have to offer, but you summed it up kind of with, I mean, you deal with a lot of retirement assets, a lot of death benefits and stuff like that, insurance. You guys kind of all have your own expertise in it, but the psychology of money is something you deal with every single client. You got to talk them off the ledge a little bit.
That doesn't matter if it's investing, insurance, like retirement. That's through and through every, in some cases are more. I mean, I would say the closer you get to retirement to actually saying, hey, I need these dollars, the more that comes into play, because the fear of what if it does drop, right? And that's a very, very legitimate fear. And one of the things we do to combat that is we call it a bucketing strategy. And so we have what we call 4 T's of diversification: tax, time, tolerance, and tools. And so all 4 of those factors go into every single financial decision we make. And so what we do is we build out a bucketing strategy to say, what are the dollars we're going to use in the next 1 to 2 years? Okay, what's that? What tool are we going to use? We know the time frame. What are the tax implications? Now, what are the dollars that we're going to say in 3 to 6 years we're going to use this? That's going to be used to replenish what we spent. And then 7 plus. And by breaking it down on that time frame, you can eliminate some of the nervousness to say, if markets are going down, you can say, hey, we're good. We have 2 years worth of income in a high yield savings account, right? You're good. Do you think this storm's going to last more than 2 years? Historically speaking, that's unprecedented basically. But if you say, hey, for the next 2 years, we're good, we can wait out this storm, we prepared for this, then it gives you the peace of mind in order to do that. And then by having that 7+ year bucket, it opens up to say, because again, historically speaking, on the S&P, for every 1 year of bear markets, we see 3 years of bull markets. Meaning, statistically speaking, the longer you're invested, the higher likelihood you're going to come out ahead, that you're going to come out with growth. Because the 3 years of growth as opposed to the 1 year of downturn. And so when you have a longer time frame, you can say, I can be a little bit more risky with this money because I have a 7-year time frame. So even if we go through an economic cycle, I can say I'm 2 years into the 7-year time frame. I got 5 years for this to recover.
Well, and going back to our first talking point here, is the retirement system broken? A lot of the problems, and you saw it in 2008, is people were ready to retire. They're gearing up to retire, but these 401ks are all locked into market, and they're all locked into, so you maybe were flush, but all of a sudden, if that 20% downturn or that market recession hits right before you're about to retire and you have just like terrible timing, I mean, all of a sudden people are in the workforce for another 5 or 10 years because they're waiting for their 401k to come back.
Well, and I think
versus a pension, which you're getting paid no matter what.
Sure. That's a great point. I think, again, lack of knowledge or experience. A lot of people don't know of something that's called an in-service distribution. And what an in-service distribution is to say, again, making up numbers, I have $500,000 in a 401k. I'm 5 years away from retiring. Well, everybody knows, okay, you retire, you're not employed, you roll that into an IRA and then it's yours, whatever. But what an in-service distribution is to say, I'm still working, but I'm going to peel off a portion of these dollars and I'm going to take them out of my 401k, roll them into an IRA, which is not a taxable event. And now that IRA can have, let's say, an annuity, which is essentially like a self-funded pension that is not connected to markets. Is guaranteed growth or into laddered CDs or into high yield savings account. Like there's all sorts of things that you can do that can protect you. And of course I'm plugging like our own services here, but that's why if you're 5 years away from retirement, you shouldn't be having the conversation when you sit down to retire. You should be having it leading up to that to say, okay, we're getting close. How do we pull these dollars out and put them somewhere that is safer, more secure, but better positioned for growth, for longevity, and those types of things? Because the person that just thinks, well, I got to leave it in my 401k until I retire and then I can do something with it, depending on the company that holds the 401k, that's most likely not true.
Right. Yeah, you're speaking a different language to me now, but I hear that and I'm like, yeah, that makes just like so much sense as far as the utilizing all these different. That's why the rich are rich. That's why the rich stay rich and become richer, is all these different tactics and systems and financial systems on top of financial systems and things that they create to do things with money, defer taxes, all that stuff. That's just like, the average person's just the average person doesn't want to have all that stuff like bogging down their mind. Like, and it's just like, I don't know how much is it constantly changing still, or a lot of these assets, a lot of these avenues have been around for a long time and are getting reinvented through digital assets like crypto. You're going to see, it's going to feel like new systems, different systems as we digitize assets, but it's going to be like the same things being recreated over again.
Sure.
Like,
yeah,
same lending systems and all that. But
well, I tell people all the time, I joke, like if this job was easy, everybody would do it, right? Or I would be out of a job, right? If planning your financial future and knowing all the ins and outs of tax legislation change and whether I can do this or how does an ESOP work as opposed to a SEP or simple, or all these, financial jargon I can throw out there. If it was easy, I wouldn't have a job, right? Just like the mechanic, if I could repair my own car, change my oil, do the spark plugs, do all that stuff, change the engine, they wouldn't have a job either because it's easy to do, but it's not. They have the knowledge and I don't, and that's why, and so, yeah, I think and I think too, like for me, again, I've never been a guy that's amazing with money. The thing that gets me out of bed is to basically say, how can I take the knowledge and execution that these sort of 1%ers or these really wealthy people, how can I pull that down and into my community to give to people to say, it's not as far as you think it is. Now, I'm not saying I'm going to make you a millionaire, but I'm saying I can give you the strategy and the knowledge to be making decisions like they're making. Now, they may be making it in the millions. You might be making it in the hundreds of thousands, but we're still going to be leveraging the sort of secrets. It's like a secret menu, right? Not a lot of people know you can do this, you can do that. And so I want to pull down those things and then provide it to our community so that more people can experience the benefit that we see the ultra wealthy doing.
Yeah, I love it. Well, we need to just have more coffee dates in the morning together, me and you.
Heck
then,
yeah, man.
I know we talked about maybe getting a group together and be on the lookout for that, because I think that we're going to put together a little group of people, and I don't know what that's going to turn into, but I'm hoping to get some people together to just talk about this stuff, because it doesn't really come up in day-to-day conversations. Money is it's kind of a taboo thing to talk to people about, because it's one of the most sensitive things. And I know that I think you maybe mentioned that in the first conversation we had. It's like a really sensitive topic, but everyone, has some of it, maybe,
Hopefully.
Well, yeah, hopefully. But what else here Is there anything else you feel like you want to add to any of these topics? Generational wealth transfer, retirement system being broken, Federal Reserve, crypto, psychology of money.
Yeah, great question. Honestly, like you just mentioned the generational wealth transfer. I think one of the things that hopefully I bring to the table in conversations that I have with people is finding ways to leverage and use life insurance in ways that are very different than the traditional understanding or model. So, analogy again is everybody knows a hammer is to pound nails, but what I'm doing is I'm flipping the hammer on its head and saying there's a completely different outcome and use of the same tool that can accomplish something completely different. And so, because wealth transfer is there's such a large sort of wealth transfer yet to happen, honestly, life insurance is one of, if not the best tool for wealth transfer, because the dollars are leveraged and they pass tax free. So if I have $500,000 of a investment, or if I have $500,000 of cash inside of a life insurance policy, more likely it's going to be $1 million or $1.5 million that's going to pass to my kids or whoever I choose to pass it to, and it's going to go to them tax free, right? And so, especially I think where I'm starting to find a little bit of a niche as well is working with younger, like 30s and 40s, that are higher income earners and want to sort of leverage cash value life insurance to create tax-free income, to create a legacy for their family, to really multiply, triple the potential, gift or passing that they can give to their kids. And so like an example of the differences in cash value life insurance. Let's say you put in, $10,000 over a certain period of time, and then it grows to be worth $50,000 in the cash. You can take $10,000 back out tax free. Whereas if I had a non-qualified investment that I had put $10,000 and it's worth $50 now, every year I'm paying 1099 taxes on that growth. And then if I've not paid the taxes on that growth yet and I pull some money out, I'm pulling from the top. I'm pulling from that gain before I ever get to what's called cost basis, the money you put in. And so there's different ways like that, because with certain types of policies, the money that you put inside that life insurance policy is invested in the market at whatever risk tolerance that you choose. And so there are ways to build out investment portfolios that are wrapped in life insurance that says, hey, if something terrible happens to me, my family's set and my kids are set. But if hopefully I don't die down the road, now I have all of this money that I get to pull back out, the vast majority of which I can do tax free. And so I've paid myself back. And so essentially you got paid money to protect your family, not die, and you did it in the most tax efficient way possible. And I think sometimes I see or hear stories in our community of I think it especially hits home for me. I have 6 and 4-year-old daughters. And just recently there was a young man that passed away from a terrible accident that has young kids. And I saw on Facebook there was a thing to get together to raise funds for his family, and which I think is great. But it's things like that I see that really get me up out of bed every morning to be like, I still need to be having these conversations with young families, because the last thing I ever want is to have a widow sitting across from me saying, why didn't we talk about life insurance? I have to find a job now. I have to make up for my husband's lost income, or I have to make up for my wife's lost income, or now I have to pay for daycare because my wife was watching the kids and, she's not with us. And so I would say that that's sort of the realm that I really start to geek out on is when we can incorporate tax efficiency and do it in a way that protects your family and builds generational wealth for you and for your kids. Like, I get super excited about that stuff. So yeah, that's kind of where I fit into the puzzle, is to say, hey, if we can disinherit Uncle Sam and get more money to our kids and start to build that for our families and our communities, like, we're pulling down from some of the top and then starting to spread it amongst our community, and that's a good thing.
Yeah, I hate the government for the most part. I shouldn't just generalize that statement, but I hate the taxes. Everybody hates the taxes.
Yep.
So yeah, I'm all for it. I think you and I are due for some more conversations here to talk about some stuff. I know, like I said, I've inherited that life insurance policy that I think I've had one conversation with you about it, but that's it. And we haven't done anything. I haven't talked about it. And I don't know. So we'll talk more. We'll figure stuff out. But certainly, if anyone is interested in some financial advice, or you guys have a 401k or life insurance policy that you don't understand or anything like that, get a hold of Matt McKinney. Reach out to him. I assume you're really easy to find on the Google machine, but how can the people get a hold of you?
Yeah, if you Google my name, or the team that I'm a part of is Lamplight Advisor Group.
Okay.
So that's kind of the umbrella of our team. But if you Google my name, then all the information will easily come up, or email, all that stuff. So,
Awesome.
And I don't love sitting behind a desk, so I love to get out and like this morning I was at my daughter's t-ball game and saw several people, bumped into them, and hey, we need to talk. I've been meaning to call you. So it's probably more likely you'll bump into me somewhere than see me on the internet. But yeah.
Well, appreciate your time. Appreciate you coming back on the show. We'll get you back on again at some point. I'd love to get a mix. I had some other finance people on. It'd be fun to maybe get you guys on together and let you guys kind of talk about stuff amongst each other. We'll see where all that goes.
Or if that doomsday ever happens, you can bring me on and say I told you so.
If the doomsday ever happens, I'll sell you some silver so you can do business in our community. No, I don't know I think it's way more likely that the end of the dollar has to be digital. It has to be something quick and easy for the people. It won't ever be analog again. I'm not like holding out hope for silver, like physical silver transactions or anything like that. But no, I appreciate you, Matt. And we could have kept probably on this conversation for a long time. It feels like there was a lot of things that we got into. Probably some good information in there for the people. I love your analogies.
Thanks,
just killing it with all those analogies. So
it's like I got the brain of like a fourth grader, so I just have to I got to make it way simpler.
I love that. Yeah. I love that. Normally I would ask my assistant to do that, but you do a very, very good job of keeping it simple.
Thanks,
so,
man.
Shout out to the sponsors here on the way out: Stumbeano's, Atlas Outdoor Services, Outstate Brewing, Victor Lundeen's, Fergus Home and Hardware, Liberty Business Systems, Wayne Schuett with Century 21 Atwood, Dr. Zack Chiropractic, and Elks Point Bar and Grill. So, Matt, you have a great afternoon. Thanks a lot for coming in, man.
You too.